So I made 9.36% on this stock. So let me first explain why I bought this stock in the first place and where did I buy this. So you see this yellow line, that's my purchase price. This red line, that is my stop loss. And on this candle, I sold the stock. On this candle, I bought the stock. So it's roughly 9.36% return, which I made. So I sold somewhere around here at the close of this candle. So that's 9.36% return. But let me explain first why I bought this stock. So you look at this base. So if I draw this base from here, this is 0.1. The low of this candle is 0.2, then 0.3, 0.4, and the high of this green candle is 0.5. So 1, 2, 3, 4, 5. So you can see price contraction. You can see that the price is getting squeezed, plus the volume during that period, the selling volume is low. That means the institutions are not selling. So this is the first reason I identified the base. Next, if you look at this base, after this candle, there are 10 candles in the base. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 candles. So I am personally looking for minimum 10 candles in the base because I want 2 weeks of consolidation. So 2 weeks is 10 candles. The third reason is if you look at the 50-day moving average, the 150-day and the 200-day, the blue, green, red, all are sloping up. The price is above these moving averages. So it's a nice uptrending stock. See how it bounces here at the blue line. So that's another reason. So the blue, green, red, the moving averages, then price contraction with volume contraction, and more than 2 weeks of consolidation. These are the three main reasons I bought the stock. So 0.1, 0.2, 0.3. So the high of this candle, point number 3, becomes my buy point. The high of this candle does not become my buy point because there is no point number 6. Okay. So the high of this candle is 4679. That's where I place my order. And on 4th of July, my order gets executed, but you see the price closes below the yellow line. But I don't panic there. I don't sell because the base is very tight. Price and volume both are contracting. Plus, if you look at the height of this base from 0.1 to 0.2, it's roughly 10%. So the stock has not given up much of its gain, which is a very good sign. And if you see this bar is a sign of institutional accumulation. See 4.9 million shares traded. So that is the reason why I did not sell on this day. I decided that I will give it more time. Decent volume coming in on that day. And next day, look what happens. It goes up 8.69%. Actually, intraday, it went up like 13, 14%. But I held on because it's coming out of a nice base. No need to sell, especially here when the volume is high. Now look at these 3 candles. The volume is declining. That means institutions are not selling. So if they are not selling, why should I sell? So this is maybe profit booking from retail traders. Then comes the pullback. This is the pullback candle, high volume. Now, ideally, I should not be selling on this candle because a natural reaction like this and a pullback like this is very much expected from the stock. And if the stock is acting as expected, why should I sell? But there are other reasons for me to sell. See, I made a previous video where I showed that I booked a loss on a stock. So sometimes to offset that loss, you have to book a profit on some other stock. So on that stock, which is ACE, Action Construction Equipment, I booked a loss of 8% here. So I decided that I will book that 9.36%, whatever I am getting. Intraday, I sold the stock. So I sold the stock at 9.36% gain and used this profit to offset that loss, which I incurred on Action Construction Equipment. That is one reason I sold the stock. Another reason is, see, the stock is forming another base here. See, this is 0.1, 0.2, 0.3, 0.4. Okay. So another base is getting formed, but it doesn't have 10 candles. I am looking for 10 candles. And hopefully those 10 candles will get completed before it breaches this high. So I will get another opportunity to buy the stock again, and I will buy it back again. But here I wanted to book profits to offset my losses on one of my previous trades. If we look at the 8-day and the 21-day exponential, see there is a nice bounce at the 8-day. This is very encouraging. Ideally, I should not be selling this stock, okay? Because when a stock bounces off the 8-day exponential like this, it is likely to go up even higher. It is holding all the moving averages. See, these moving averages are sitting on one on top of each other. 8-day exponential, 21-day exponential, 50 simple, 150 simple, and 200 simple. Okay. And the stock price is going up nicely above the moving averages. Okay. See how this keeps tagging along the 8 exponential moving average. So that orange line is a very important line. Okay. Let me remove the moving averages. Yeah. So that's my stock, around 9.36% gain. As you can see, the price comes nowhere near the stop loss. So the stop loss is at a very safe distance. The base itself is 10% long. And here my stop loss is 8%. And of course, I forgot to mention my position size. My position size is 2.5%. Here, 2.5% of my entire portfolio, trading portfolio. And I used this profit to offset the loss on another trade. Ideally, I should not be selling a stock which is acting as expected. Okay. So I would consider this as a partial mistake, something which I should not have sold, but I had to do it to offset some other stock. Sometimes, as a swing trader, you have to do these kinds of things. Okay. I hope you learned from this. If you have any questions, just let me know in the comment section. Thank you so much.